Thanks, Kathy. Sorry about that. Hi, everyone, and welcome to today's webinar. My name is Anna, and I'm with the New Mexico Small Business Development Center. Today, we have Cathie Tardy joining us, who is a certified SCORE mentor, is a CPA, and holds an MBA in tax accounting, and has been the president of her accounting firm for 31 years. Did I get that right? An MBA in tax accounting, Kathy?
Yes.
Just want to make sure I didn't misspeak there. Okay, thanks.
Exactly.
Kathy will be presenting tax strategies, keeping your profits in your pocket. If you wouldn't mind progressing to the next slide. Thanks so much, Kathy. We'll be using the Q&A function to take questions and welcome attendee participation. So don't hesitate to ask us any questions you may have. We'll answer those questions during and at the end of the webinar. We love questions around here, so don't be shy. And the following slide features some COVID-19 business resource links, which I won't go over in detail now, but we will go ahead and send those to you, the entire presentation actually via email at the end of the webinar. So be sure to keep an eye out for your email. Please visit our website at nmsbdc.org to view our upcoming no-cost webinars or to sign up for no-cost counseling services. I'll also send a follow-up email to you with this information. Thanks so much for joining us. And without further ado, I'll hand it over to you, Kathy.
Thank you. Well, today we're going to talk about keeping our profits in our pockets. And just as a quick overview, we're going to hit 10 items. I kind of fill in with a few sort of sidebars on some of these items, but this is what we're going to be focusing on today. And so let's talk about, in general, tax planning and where that all begins. Because when we are thinking about tax planning, we can't just think about the tax laws. We have to think about really what's going on in the world. What kind of business are we in, and how is what's happening in the economy affecting our business? There's been a lot of things happening recently, more in Ukraine. We've got inflation, high gas and oil prices, and a lot of supply chain issues. So there's a lot of different things going on in the world that are going to impact our business, and we need to be following them and thinking about how that's going to impact our business. Excuse me. Someone's going to help with that. So anyway, so what current issues have affected our business, and how is it going to affect our business? Is it going to create us opportunities, or are we going to have some issues that might actually make our business decline? If we can't get supplies, how are we going to change what we're doing? What are we going to do? So planning to figure out what we're doing. So one good way to get some information too about your specific industry is to go towards your industry groups to see what they're predicting for the future. You know, how the inflation is going to affect and different supply chain issues. So talk to your industry groups. The next thing you need to do is to consider your projections. So when we talk about projections, we're talking about not just, what are we going to do this week, this month, but what are we going to be doing this year, next year, and really we should have a projection out for 3 to 5 years. I know people tell me, it's really hard to know what's going to happen, and I agree, it's hard to know what's going to happen, but we need to have some plans so we can try to make things happen that we want to happen. So really, I'm a very strong proponent of people having projections at least for 3 years. And along with projecting what our income is going to be, we also need to look at our cash position, because as we all know, cash is king, and we need to have it available for us if there is investments we need to be making in the business. And if there's a certain slow time for the business, do we have access to perhaps a credit line? Do we have a credit card that can be used? And I know people hate to use their credit cards, and I agree, because those interest rates are out of sight on some of these credit cards. So be very cautious with them and really only use them for a short-term situation. Along with what's happening in the world, what's happening in our business, we also have to look at what's happening in our personal tax situation. And we need to consider this because a lot of our business owners are operating as a pass-through entity, either as some type of LLC, be it single member or multi-member LLC, or an S corporation. And so when these businesses are throwing off income from their K-1s to the business owners, we need to understand what's happening on the personal side as well, so we can factor that in our planning. So not just business, and maybe we have more than one business, and maybe one is a Schedule C business, or we have a rental property. So we have to factor all of these things in when we're doing overall tax planning, as well as on the personal side, of course, personal tax deductible expenses, maybe home mortgage, that type of thing. Maybe we have home offices. And again, we need to consider cash needs on our personal side when we're doing our projections. So not just what do we need for the business, but what do we need for ourselves personally. So let us keep our profits in our pockets. Let's go into the first issue that I wanted to discuss today. So that is, what is your filing status? And that may seem very obvious, single or married filing jointly, but there are other options that we need to consider and think about. Perhaps we may file as head of household. We would be an unmarried individual, but we're providing over half the cost of support for an individual, be that a child or even perhaps a parent. So we want to consider this if it's a possibility for us. We get some special tax breaks if we file head of household. Sometimes we also file separately. In the state of New Mexico, being a community property state, we don't see this a lot because it creates, it's the highest tax bracket, and we lose some of our special exceptions. And it's used sometimes when we need to just make sure that we keep these items separate from our spouse's situation. Also, too, in a year of divorce, if you're divorced on the last day of the year, you're single. And so although there may be some community property splits for the part of the year when you were married, you're actually going to be filing single if you're divorced by the last day of the year. And also, too, you may have a birth of a child, which may allow you to use the head of household, or you may have moved in your parent or some other individual who may qualify you for this head of household. So be sure to take a look at that if you may qualify. So the next thing to understand is who is a dependent. And sometimes we have dependents that we didn't know we had. We always think, of course, of our children as our dependents, and they generally are. And for a qualifying child and a qualifying relative, which I'm going to get into a little bit more, you must be filing single, married separately, or if the dependent files married, they're only filing to get a return of withheld income taxes and not to take any other benefits. They must be a citizen at least part of the year, or a national resident alien, Canadian or Mexican resident, and you have to provide over half their support. So a qualifying child is obviously son, daughter, stepchild, foster child, adopted child, or even could be a grandchild, a brother, a sister, a half brother, a half sister, step brother, step sister. So you can see that it isn't just a qualifying child. There's quite a number of people who would be categorized under this qualifying child dependent. But to make these tests, they must be under age 19 or under age 24 and a full-time student, unless they have some permanent disability. Their principal place of abode must be with the taxpayer, meaning they must live with you for over half the year. And unless they have some kind of special exception for living not living with you for over half the year. And one of those ones, of course, is when your child is at college, they're considered as having lived with you for the year. Now, this is the qualifying relative. And again, there's quite a few individuals who could meet this test. We've got, again, son, daughter, stepchild, foster child. You can read through all of this, but it also includes aunts, uncles, nieces, nephews, grandparents, or other, like maybe great aunts. So basically, anyone who is somehow related to you or living with you and you're supporting them, and they must have lived with you for more than half the year, and they have, again, some of these special exceptions for being included as living with you for half the year. But generally, the big test is they must have less than $4,400 in gross income in 2022 to meet this qualifying relative test. So you are probably aware of the child tax credit, and for 2021 we had this special credit and we had the advanced tax credit, and we are going back to the old rules for 2022. So children 17 and under qualify if they meet the 6-month or more U.S. citizen, that test, and the tax credit is $2,000 per child for a qualifying child. For the qualifying other relative, the credit is $500. There is a phase out for modified adjusted gross income at $400,000 for married filing jointly, where you start losing the credit, and $200,000 for the other filing statuses. The additional child tax credit refundable portion is projected to be $1,500 per child for 2022. So item 2, and this is one of my favorite topics. This is what I'm going to be doing in my retirement, to stay away. But anyway, retirement plans. These are very good for not only saving taxes, but also for getting nice deductions in your business as well. So there's a number of different plans that you can contribute to, some deductible, some not. We have the 401k, we have a solo 401k, and that would be for perhaps a single member LLC or a single member S corporation. We have a SEP, we have a simple IRA, and we have a Roth IRA, and of course we have the regular IRA as well. And so some of the things that you need to consider is, when do these plans need to be established? For one thing, of course, the earlier the better, because our contributions grow because of the increases in the market and compounding. And so the other factor that's so important is we need to get them established so we can make the contributions and have them deductible. So the first one I wanted to talk about is a safe harbor 401k. It must be established by October 1st, before the year that you're going to be making these contributions. And the reason it's October 1st is because you have to give your employees time to understand the plan and understand what's available to them. So remember that it's already April, and time flies when you're having fun and you're busy in your business. So start thinking about this if you haven't set something up now. The solo 401ks, they actually give you a little bit more time. You can establish them by the end of the year, but that's because you're the only person. You don't have to notify anyone else because you're the only one who's eligible. So they have to be established by December 31st, and the contributions have to be made by the due date of the business tax return. And so generally that's going to be March 15th, April 15th. But if you take an extension of time to file, you have until that extended due date to make these contributions to the 401k. So that's kind of a nice little benefit as well. The Roth and regular IRA must be contributed to the plan no later than April 15th. There's no exceptions to that. The SEP can be set up and the contributions made by the due date of the tax return, including extensions. So again, the SEP is a nice plan. The SEP, though, comes with, depending on how many individuals are in your company, if you select a 20% contribution for yourself, you will make a 20% contribution for all your employees. So sometimes the SEP is more beneficial if you're a single worker in your company. The simple plan, again, has to be set up by October 1st. And again, that's due to giving your employees notice that the plan is available for them to make contributions into and understand what their options are. Okay. Now, I say those are the dates when you have to have them set up by, but I also say we need to be really careful because the providers of these plans need more time, and especially if you're going to do maybe a safe harbor or you have some special things you want in your 401k, you need to be thinking about getting these set up at least 5 days, but sometimes way more. You probably, like I think that if you're going to get it set up by October 1st, you better be thinking about it and talking to somebody by at least a month before to make sure everything is set up and set up in the way that you want. So maximum contributions, and these are pretty large. See, for the 401k, you can put in $67,500. Now that includes the deferral of $20,500 if you're under 50, plus the $6,500 catch-up contribution, deferral contribution if you're 50 and over, and then the employer can make contributions up to 25% of your compensation. So for the total deferrals and employer contributions of $67,500 for the year. So this is a really great planning opportunity if you've got cash in your business and you're trying to maximize retirement savings. The 401k can be a great vehicle to use. And especially if you're the only one in your business, again, $67,500, you would use the deferral of the $27,000, and then the business would contribute the rest to your 401k. So that's a really wonderful opportunity. Now the Roth IRA and the regular IRA, their maximum contribution is $6,000 unless you're 50 or older, and then you can make an additional $1,000 for $7,000. The SEP is based on your income, either your W-2 if you're an S Corp, or your self-employment income if you're filing as a single member LLC, and that can be up to 25%. So sometimes this is a nice plan if you're just one person in your business, because the SEP is easier to administer. The 401k is going to come with some costs to administer and eventually some tax returns that need to be filed. The simple, again, is another one that is low cost, but your maximum contribution isn't as much. So you can see that the maximum deferral is $14,000 plus another $3,000 if you're 50 or older, and to a maximum of 100% of your compensation if it was less than those amounts. So not as, doesn't allow you to hold back as much as you would like. The next item I wanted to talk about is this Section 179, and I know people know about this and have talked about it for years, and one of the big things that they always think about for 179 is, I'm going to buy that big pickup truck or some big vehicle to just and deduct the whole thing, which works in certain circumstances. But so let's talk about that. So we call that special expensing, the Section 179, and you can purchase up to $2,700,000 worth of items for your business and still be allowed to take a Section 179 deduction, but the deduction is up to $1,080,000. So basically the 2.7 million is a cap. So if you purchase 2.8 million in assets, you wouldn't be able to utilize the 179 deduction. Another thing to know about Section 179 is not only do you have to purchase it by the end of the year, you must actually place it in service by December 31st. So you can't just have it sitting in the warehouse. If it's some kind of equipment, you need to at least get it turned on and use it once by the end of the year. They changed the rules in the last few years where now you're eligible to take the Section 179 special expensing on a rental property. So that's a nice fact to know. But the thing I always say, and getting back to keeping our profits in our pockets, is to consider the actual need. Do I actually need this, or am I just buying it because I'm thinking I'm going to save some taxes? The other thing, of course, to consider is the cash flow situation and even financing options, because if we purchase something, equipment, and we finance it, it's still eligible for the 179, even though we haven't paid for it all by the end of the year. Bonus depreciation it kind of comes and goes through the tax code. It's available to us now, at least before they change the tax laws again. But through 2022, you can take 100% bonus depreciation, which basically means you're going to deduct the whole cost of the item. And so that's a really nice factor to consider. Again, it's going to be phasing out over the next few years, 80, 60, 40, 20, and then after 2027, it's going to be 0, and we're just going to get regular depreciation. But interesting to note, you can take Section 179 and bonus depreciation. So in a 100% year, it doesn't seem like it's very effective, but in these other years, it could be very effective to be able to take them both. One of the other things we want to think about when we're trying to do tax planning, keeping our profits in our pockets, keeping our taxes down, what's happening with tax rates? Well, I think we all have heard about the president's proposals to raise taxes in a number of different ways. So in our situation, we really think that tax rates are going to be increasing. So what do? So there has been talk, it has since they changed the rules, of limiting our state and local taxes to $10,000 deduction, of increasing that. And actually some states have devised a way to get around these limitations of the $10,000 for the state and local taxes. And that's something to look at when you're filing in these different states, how to best utilize that. We may decide to pay some property taxes in a different year. We may change when our employee bonuses are paid. If tax rates are going to go up next year, we may hold the bonuses until January of next year instead of paying them on December 31st. A similar thought process with charitable contributions. Maybe we hold them until next year, or maybe even double up on them next year. And then something that some people are unaware of is that credit cards are a good way to get a deduction in the current year, because the IRS allows you to put something on your credit card by December 31st, and even though you don't pay off your credit card, allow you to take that deduction in the year. So that's something to keep in mind as well. Now, I have this slide for tax rates decreasing. I don't think that's going to be happening anytime soon. But again, we would go in the opposite direction, maybe pay things in such a way so we get to take the, push them into the year where the taxes are higher, and so we get more bang for our buck. So let's talk a little bit about cars, trucks, and vans. They're actually treated differently. There's not one rule for everything. but the standard mileage rate is 58.5 cents for 2022. We need a log. Heaven forbid you get the IRS notice and you don't have any mileage logs for them to look at. It's an immediate disallowance of that deduction. There's a really nice app, MileIQ, that I like to use. It's inexpensive and you can use it on your phone and it's really easy to use, and it will map every single trip you take, and it's easy to determine and let it know which ones were personal, which one were business travel miles. So there's really no excuse to not have some kind of a log these days. Only miles from your business office count. So we can't take commuting miles, meaning coming from the house to the business office. We have to get to the business office first and then take miles from there. And so I'm going to talk about a home office in a little bit. And I often get the question, what is better? Is it to take the actual cost or take standard mileage rate? And I found over the years that generally the standard mileage rate is going to give you the biggest deduction, especially if your car is newer. But as your car tends to age and need more repairs, then the standard mileage rate sometimes is a bigger number, and you can switch every year and pick which one is the best for you, as long as you pick standard mileage rate the first year you place that particular vehicle in service. So we normally track both miles, which we have to do anyway, as well as actual costs, and then do a comparison at the end of the year for tax purposes. So for the vehicles, there's different rules for depreciation, 179 for bonus. But the thing to realize for these vehicles, 100% business use is pretty easy to understand, but we must use them at least 50%, and we can still get prorated on some of these deductions. So generally, how the IRS describes these vehicles are, it's a passenger vehicle, an SUV, or a vehicle over 6,000 gross vehicle weight. And oftentimes you'll see me Googling how much is the weight of this particular vehicle. That's not an SUV or a passenger vehicle, but some of the larger trucks and things, because they get special deductions. So the passenger vehicle is limited to $18,200, which includes both the first year bonus, depreciation, and $10,200 without that, just using Section 179. So you can see, combining the 179 with the bonus, we do get a bigger deduction, that $18,200. Now for an SUV, they are eligible for the 100% bonus depreciation, and the 179 is limited to $27,000. Trucks over 6,000 are eligible for a full 179 deduction and the 100% bonus deduction. So these are the vehicles that people like to buy to have massive tax savings at the end of the year. But again, keep our profits in our pockets. Let's only buy it if we really need it. All right, let's talk about home office. This is another deduction that people sometimes are afraid to take. Sometimes they've been told, oh, don't do that. You'll have to pay taxes when you sell your house. So first off, let's talk about what is a legitimate home office. And it's the principal place of your business, which means that you're using it on a regular and exclusive basis. You can perform just administrative and management activities in the office. There's a case that really decided it all for us, the Salomon case of a doctor who was performing surgery. And so the IRS tried to say, well, that's not his principal place of business because that would be the surgery. And so it went to court, and it was decided that because he was doing all of his billing and his scheduling and all of his administrative duties, he could have a home office. So it's not limited to you must receive clients in your home, not required. It is true that depreciation may create taxable income on the sale of your home. Right now, we have these exclusions of 500,000 married filing jointly, 250,000 single individual on the sale of your home, gain exclusion. But the gain exclusion may be reduced by some of the depreciation you take. But in my experience, these are fairly small depreciation deductions and don't have a very big impact on the sale of your home. So talk about it with your tax professional and see what you would like to do in that area. Now I put in here needed for mileage deduction because it really is very important. You need a place to leave from to get your mileage. If you have a legitimate home office, now there is no commuting mileage because now every time you leave for a business purpose, it's business. So you can really, if you qualify, you can really get a much bigger mileage deduction, keeping our profits in our pockets. And we need to be very careful to make sure that we have a legitimate home office. It does not have to be a whole room. It can be just a section of a room, but you must use it regularly and exclusively, meaning you're not doing anything else there. So a really important deduction in my mind. There is a safe harbor. You still have to meet all the qualifications, but instead of figuring out all of the utility bills and all the different things that are involved in home ownership, you can use up to 300 square feet. Of course, you have to use your actual square footage of your office and then multiply it by $5. So a maximum of $1,500. But that may be what gets you a ton of mileage. So consider it. Do we want to accelerate income? Because again, if tax rates are increasing, maybe we want to push more income into the lower tax year. How do we do that? Maybe we encourage early payment by our customers. We may try to get closings happening sooner. We can actually prepay some rents, which is a good one to consider. And so trying to shift our income. And again, you can't do this if you're not planning. So planning is so very important. They were talking about increasing capital gains tax rates. And so if that's happening, maybe we need to take some of our gains, accelerate the income into this year where the rates are still favorable. Here is a chart that shows what the tax rates are and the brackets for single, married filing jointly. I didn't put in head of household. They're slightly different from single up to the 22% bracket, but then they are the same as the single. But so you can see where you can try to keep your income in a lower bracket. And especially with married filing jointly, if we have two wage earners, that's a pretty big bracket. So we want to consider our brackets too when we're talking about accelerating income. Is that going to push us into a higher bracket? We need to be aware of these things so we know how we can do our planning and be effective in our planning. The corporate tax rates. I was doing this presentation before they changed the C Corp rates to a flat rate of 21%. But I did keep the brackets because I thought it was really interesting. And they're talking about increasing the corporate rates again, maybe 28%, maybe 26%, maybe going back to brackets. So we don't know. But for right now, the C Corp rate is a flat 21%. And again, sometimes this is good if we have a C Corp. Maybe we want to leave some of our earnings in our C Corp for future investments, and we can cap our tax rate at 21%. Whereas if we pass it through for an S Corp, maybe we push ourselves in the 24 or even 32% bracket. So let's be aware if we have a C Corp, how we can utilize those brackets, or even in a multiple company situation. Another idea that I find a lot of people don't utilize, but they could, is having your children work for you. Now, I don't mean, giving your 2-year-old a paycheck, because we have to have some kind of reasonable compensation situation here. So if you have some things that your child could do, I mean, even as easy as maybe taking out the trash, maybe cleaning the bathroom. Everyone hates that job, cleaning the bathroom. But we could pay the child reasonable compensation for doing these duties. Not only are they eligible to make an IRA contribution, so we teach them early to start saving for retirement or maybe even college, maybe putting it into a Roth where we get some tax deferred earnings, but they also could, and these are older children filing their own tax returns. The standard deduction is $12,950. You could shift $12,950 from your tax bill to their tax bill, and they basically pay zero tax. So it's a really nice way for some of your older children to actually work in the company and save you money, because maybe you'd be paying at 24%, and even if they were paying at 10%, you'd still be saving that 14% overall as a family in taxes. Another thing to consider for children is to gift them income-producing assets. Sometimes this may be a rental property. And generally, this is going to be for an older child as well, like 18 or older, and shifting that income, again, keeping it in the family, but shifting it to the kids. And so maybe they're paying for college by the income from the rental property. And also the thing to consider, though, is if you gift them things like stocks and bonds that are going to generate investment income, they have to keep that below $2,300, or else you're not going to get that tax savings. It's going to go back to the parents' rates. So there are a few things to be aware of in that particular situation. And talking earlier about selling some stocks and things to create capital gains, let's look at our whole portfolio. Maybe it's time to sell some of those losers we've been kind of hanging on to and hoping and praying they're going to come back. And maybe it's better to get the tax loss for them. So, you need to think about what's in there, talk to your advisor, is it wise? Is this really going to come back? How are we going to deal with this? But so should we take profits too and offset that with the losses that we can generate? Maybe we have something with an unrealized gain of $10,000 and another item with unrealized loss of $12,000. So we could offset that gain, get a $2,000 loss deduction on our return, and then minding the wash sale rules, get back into the position of the stock that was on a gain that we really didn't want to sell, but did because we wanted to take advantage of those losses. And also, too, maybe taking care of some carry forward losses that may be available to us. So right now, capital gains rate is either 0, 15, or 20%, depending on what your tax bracket is. And so for single up to $41,675, you're at the 0% tax bracket. So again, here's an opportunity. And up to $459,750 is at the 15%. And then once you get over that, you're in the 20% bracket. So again, be aware of what bracket you're in when you're looking at your capital gains. You're filing jointly, here's the numbers. At a household, here's the numbers. And then for the offset, like I said, matching losses to gains, because there is a special rule that says capital losses are limited to $3,000 for married filing jointly or $1,500 for single individuals. What that means is, so if you had $10,000 in gains and $15,000 in losses, that would net to a $5,000 loss, but you'd be limited to $3,000 loss if you were married filing jointly. But you can carry that loss into the next year or future years. So it's not loss, it's just a limitation in the particular tax year. Another thing when we're talking about portfolios is mutual fund timing. and I'm sure your broker can tell you all about this, but we need to know when we should be buying and selling, because there are certain things that mutual funds are required to do, and when they calculate their capital gains and allocate it to your portfolio. So we want to be aware of, if we're just getting into it, maybe we want to wait a few days and have them declare and get those gains distributed to others before we buy in, so we don't end up with a tax bill we weren't anticipating. And of course, knowing when our dividends get paid. And if you're not working with a broker and you are investing in mutual funds on your own, of course, you can call the funds themselves to find out what's going to be on your 1099 for the year. I see maybe there's some questions, or is that?
Yeah, we do have some questions. Cathie, did you want me to go ahead and tell you what they are real quick, or did you want to wait until the Q&A?
Yeah, no, if they're relevant to what we're talking about.
Okay, yeah, I think two of them at this point are a little bit outdated because they're from previous slides, but the most recent one is, what exactly are capital gains?
Capital gains. Okay, capital gains are when you have an asset and you hold it for more than a year. That's a long-term capital gain. So meaning you purchased the item for, say, $5,000, and now you can sell it for $10,000. You've got a capital gain, and depending on if you hold it for a year or more, that would make it long-term.
Thank you so much for that, Cathie. I might as well just go ahead and tell you what the other two questions were. Is that okay for now, or did you?
Sure. Yep.
Okay. One of them is, can you use an RV as a home office and business travel use?
Yes, you can. You can use it actually as a second home, so it would be available for home office. But again, you have to be extremely careful, because IRS likes to think that, you know, everyone is suspicious. And so regular and exclusive use for the home office. And you can take mileage if you're using it for a business purpose, but you need to have very good records to isolate what's really business and what's personal. And if you're just driving around the country because you want to see it, that's not necessarily business miles.
And then the last question that we have is, can rental property be out of the US?
Well, yes, you can have rental property out of the US, but as a US citizen, your worldwide income is taxable. And this is one of IRS's big pushes right now, and why they're asking, do you have a foreign bank account? Do you have any foreign assets, any foreign trusts, any foreign anything? You're required to file if you're generating revenue on those rental properties out of the country. So yes, you're perfectly eligible to have them and take advantage of the rules, but you must, report them on your taxes.
Thanks so much for that, Cathie. I think that's it as far as questions. I'll keep you updated and let you know if anything else pops up.
Okay, thank you. Again, this is one of my favorite topics to discuss, choice of entity, because people think that, well, I set up as an S Corp, so I have to be an S Corp. Well, no, that's not true. And sometimes we change the entity when we're doing our planning sessions because a different entity is going to make more sense for the individual. A lot of times what I see is individuals create a business and set up an LLC because that's what everyone told them to do. And that's fine. And as they move along, the LLC serves them well. But as they get a little bit bigger, they're finding that they're getting killed with self-employment taxes, because as an LLC, generally all the income that you make from the LLC is subject to self-employment tax. And sometimes we say, well, maybe we should go S Corp, because if we use reasonable compensation for our salaries, then we can take some additional distributions that won't be subject to self-employment tax. And that works really well for a lot of companies that are service providers, or even have a number of people working for them and generating income. So, for example, a company that maybe has 10 or 12 individuals and they're out selling things, and the company is doing really well. Well, if it's just an LLC and it's passing through to the owner, that's all subject to self-employment tax. Whereas if they made an S election and did a reasonable compensation study, a reasonable compensation for them may be a much lower number. Maybe it's 150,000 instead of 250,000, and so they could save that self-employment tax on that difference. So that's really something that I like to look at when I'm talking to my planning clients. And so sometimes too, corporations versus individuals. Again, sometimes we'll actually create a C corporation because we want to pay out huge deductible benefits to our owners. And if they're the only individuals in the company, we can do that and basically shoot for zero taxable income by bonusing out, or not really bonusing, but by providing all of these deductible employee benefits to the owners. And we pay zero taxes in the C Corp, and then they just get a regular W-2. But they've gotten huge contributions to retirement accounts and deductible life insurance and other things like that. Something to also consider is, and this one is pretty much unchangeable, but when we set up our company, we have to decide if we're on a cash basis for tax reporting purposes or accrual basis. And sometimes it's actually more beneficial to be on the accrual basis because of how accrual shares the income and expenses with the proper period versus cash, which you can artificially create, bigger deductions and things at the end of the year just by actually expending cash. So, let's think about the type of business you have and what makes more sense, the accrual versus the cash method. Now, a special rule for the accrual basis business owners, or if there is an actual accrual on your books at the end of the year that you're going to take for tax purposes, you must pay those expenses no later than 2.5 months after the end of the year. So it gives you a little break on your cash flow. And related party accruals generally are not going to be deductible. So, should you change your entity? When do you do it? What makes the most sense? And so, again, you've got to be thinking ahead and planning. Is this something we're going to do next year? Or is it actually going to be a couple years on down the road? And again, compensation versus distributions. We could have some significant tax savings on payroll. But again, higher compensation means higher payroll taxes, but it could also mean higher retirement contributions because some of these calculations are based on what your earnings are. So if you're really trying to max retirement contributions, you may have to pay a higher salary to yourself to be able to utilize those. And then again, self-employment taxes versus payroll taxes. Let's keep our profits in our pockets. So this is a summary of the 10 items that we went through. And just kind of as a little recap, filing status, often forgotten, is the head of household. Let's consider that for, maybe individuals living with us who are not our actual children. Let's consider it for our parents. And then related to that is, who is our dependent? Do they qualify? And maybe we were thinking they didn't, but if they are not earning anything, maybe they do actually qualify as a dependent. And again, one of my biggest ones that I love is the retirement plan. I had a client say to me, and I've been doing this a long time, thank you so much for making me start with that retirement plan because now I can retire. I really can retire. And he has close to $2 million in his retirement accounts, and he's just in heaven. So seriously, even if you can only put a little bit away every year, please, please, please do so. The Section 179 and bonus, again, let's utilize those to our benefits, but let's not buy things we don't need. Let's consider our cash needs, both business and personal. Accelerating income. If we think next year the rates are going to be higher, let's push that income into this year. There's no reason to pay it at a higher rate. And again, deferring deductions, I don't think our tax rates are going to go down, so that one may not be as beneficial as the accelerating income. And let's be creative. Let's think of ways to encourage our customers to pay us in advance. The seventh item, again, child labor and child gifting. This can be very beneficial, and especially for earners in that higher bracket that have children in college. This may be a wonderful way to, instead of just writing the checks for college, have the children working and participating in the business and basically shifting the income to the child legitimately at a much lower rate. So you are saving taxes for the family, or gifting that rental property to the child. That's another wonderful way to help them through school. The capital gains and losses. We talked about what a capital gain is, and generally we think of capital gains relating to stocks or bonds, but we do have capital gains on rental properties if we're selling them. So basically anything that you hold that increases in value, maybe even some kind of artwork, that type of thing, capital gains may be available on that sale. We want to understand about our mutual funds, talk to our brokers or the actual mutual fund companies themselves to see what makes sense. When are these things getting paid? Is that going to affect my taxes for this year? Do I hold off? So things to consider. And then, of course, my top 10 choice of entity. And I love this one, and it's great for new business owners in the business for 5 years, 10 years. And sometimes, there's so many opportunities to do planning. Sometimes we even do some spin-offs or split-offs of different types of businesses. Entrepreneurs are really great at starting multiple businesses, and oftentimes they'll end up in the same company, but maybe it makes sense to split them off and treat them as separate. And so again, choice of entity for those companies as well. So there's lots of things that we can consider to keep our profits in our pockets and do our business planning and tax projection planning for the year. And do not wait. We should be doing it now. We need to know where we're going to be so we can make it happen. So that is my summary of my top 10. And we want to avoid the IRS, so let's keep our profits in our pockets. Do we have any other questions or comments or things that you'd like to share?
It looks like there are some questions that just popped in right as you said that. So perfect timing. One of them is it true that if you choose a sole proprietorship that you can do taxes as a personal income tax?
Yes, a sole proprietor is generally going to be taxed on a Schedule C on your Form 1040. So it's all included in your personal income tax return. That Schedule C is, if you look at it, just like a profit and loss statement from your business, and it'll show your revenues and your expenses and things. And you're eligible for a home office. You're eligible for Section 179. You have all the same opportunities, and you'll be paying self-employment tax instead of payroll taxes. So that's a couple things to consider when you're looking at a sole proprietorship.
And then the last one is a more general question in regards to resources that are available to help make these decisions and whether or not SBDC services are available that can be used. And yeah, I would say definitely reach out to us here at the New Mexico Small Business Development Center, because we do have no cost free counseling services. And we can direct you, from there once we know more about your specific scenario and individual circumstances. And that's just a reminder for anybody that to please visit our website at nmsbdc.org to view those upcoming no-cost webinars, and also to get some more information on the no-cost counseling services that we offer. As far as additional questions, I am not seeing any. I'll give it just another second. Again, don't be shy. And in the meantime, also just wanted to let you know that we have a basic bookkeeping webinar coming up on April 12th. I believe that's Tuesday of next week from 2:30 to 3:30. And we also have a webinar that covers kind of the basics to starting a business. It's called Converting Your Business Idea into a Profitable Company. That's on April 13th from 3:30 to 4:30. I've chatted through all the links. I'll go ahead and send through the link to register for these webinars. Again, please note that you cannot copy and paste for some reason out of the chat box. So you'll have to actually click on the link and then you can copy and paste it if you want to use it from there on moving forward. Again, all this information will be sent to you via email. The webinar will be made available on demand so that you can watch it again. We have some more webinars coming up, so you can register for those as well. And I think I've covered it on my end, Cathie. I don't see any more questions. So if you want to just kind of wrap it up on your end, if there's anything you want to say, feel free to.
Yeah, I think everyone should take advantage of the SBDC and what they offer. A lot of free services, and they're very well done. And also SCORE as well has mentors who can help. And so please take advantage of it. Everyone is happy to contribute their time to make you a success. And I want to thank you for joining me today. I hope you learned a few things. And again, always question. There's opportunities, and let's ask the questions so we can take advantage of them. And thank you for watching.
We've got a lot of thank yous coming at you, Cathie, just to let you know. So thank you all for your attendance. And Cathie, as always, so much for your time and your expertise. And we'll go ahead and wrap it up with that.
Thank you.